What did we learn this week about the U.S. economy?
It's great to be here. I think the information we've gotten this week has been very encouraging. On the growth side, mostly good news, another drop in jobless claims, and a clearly stronger than expected retail sales number. That was very reassuring in light of the weaker employment report for July and the concerns around the consumer at the bottom-up level in some of the earnings reports. In the macro data, we're not seeing the consumer softening sharply. And I think that's the probably number one takeaway as far as economic activity is concerned. There were also some more mixed numbers from industrial production and housing starts, but I would put more weight on the consumption news than on those.
We also are down to a 2 number, starting with the 2 at least number on the headline CPI. So are we getting inflation under control? Is it going to continue in your opinion?
I am very optimistic that inflation is largely in the rearview mirror. If we look at the July core PCE estimate that we get on the basis of CPI, PPI, and import prices, we are at 13 basis points, which is yet another sign that we're on our way back to 2%. Now, in terms of year-on-year rates for core PCE inflation, it's going to be difficult to make a lot of headway in the second half of the year because the year-on-year comparisons are becoming more difficult. We had very low sequential inflation rates in 2023, but I think on a 3-month annualized basis, a lot of the underlying trend measures are saying we're pretty close to 2%, and this is no longer a major issue for monetary policy.
As is always the case, there are some ups and downs. Some things are a little better, things are a little worse under the headline numbers. But what about housing? Does that give you any pause with respect to how much control we're getting over inflation?
Well, I think the rent numbers were a little higher than expected in the most recent release. But if I look at the trend in rent, we are seeing a deceleration in rent, in owner's equivalent rent. There are some alternative indicators from the Cleveland Fed and the Labor Department that break down rents into new leases and existing leases. Those are showing a clear trend towards improvement. And I think just based on our modeling of how new lease prices translate into the overall CPI numbers, there's a very high confidence that we'll see ongoing gradual improvement. The other point I'd make on inflation is what are we seeing on the labor market? We've seen the labor market rebalance. The unemployment rate has drifted up to 4.3%. We've seen very large declines in job openings and quits. We've seen a very material deceleration in wage growth. The latest average hourly earnings number was only 3.6%. And that basically says we no longer have a significant labor cost issue. Unit labor costs were up only 0.5% on a year-on-year basis in the second quarter. So all of that is very encouraging.
Where are you right now on the possibility of recession? When we started the year, a lot of economists were really almost predicting recession. Larry Summers, for example, in this program was saying it's more than 50% likely. That's changed over the course of the year. Where are you on that right now?
So we were at 15% coming into the year. We lifted that from 15 to 25% on a 12-month forward basis after the employment numbers for July. Not only because of the employment numbers, we also had seen a couple of higher initial jobless claims numbers. We'd seen some weak survey evidence. We'd had some negative anecdotal information about the economy and the consumer in some of the earnings reports. So we lifted it somewhat, but I'd say 25 basis points is still, of course, well below 50. It's still somewhat below the consensus. I'd say at the margin, what we've seen over the last 2 weeks has been encouraging. So I think the likelihood is that 25% is going to come down again. I would like to see a little bit more information, especially, again, the next employment report, just given the predictive value that we've seen historically from labor market information for recession that's encapsulated in the so-called SAM rule, that if you see a 0.5 percentage point increase on a year-on-year basis in the unemployment rate, historically that's been a very strong recession predictor. I think there are some good reasons why that rule may not hold and probably doesn't hold in the current environment. In particular, the fact that we've seen a very large increase in the labor force, very large increase in immigration, and that's really, in our view, the main reason for why we've seen a higher unemployment rate. Employment is still growing at a good pace, despite this latest somewhat softer number. Overall, still seeing very strong employment growth, and so it just seems like a different type of increase in the unemployment rate that's probably not as predictive of recession. But it's hard to be sure, and that's why we are, hedging a little bit more.
We had some important economic data out this week. Next week, we have the meetings in Jackson Hole, where a lot of central bankers, including Jay Powell, the Fed chair, will be gathering. What do you expect to come out? What are you anticipating? What are you looking for in those meetings?
Well, I'm certainly expecting a signal that the next move in interest rates is down and is close. That was already clear at the most recent press conference when the Fed decided to stay on hold. We actually thought that there was already a strong case to cut at that meeting, but they decided to stay on hold and signaled pretty clearly that a rate cut is on the table for the September meeting. The news that's come in the meantime, in particular the employment numbers, I think cements that. That will be visible in Chair Powell's remarks. He's not going to give us details. I don't think we're going to learn, for example, whether it's going to be 25 or 50. But I think there will be a recognition that inflation has come down very substantially, that we're on our way to 2%, that the committee is more confident of that, and that will set the stage for a normalization of the monetary policy stance. I think there could be a discussion of labor market softening, and maybe you could talk about the distinction between benign labor market softening and more concerning labor market softening. Perhaps talk about some of the issues around immigration and in particular labor force growth. It's very difficult to know what he will choose to emphasize, but I think those would be some very sensible topics to address.